Firms often have to make financing decisions. Should the firm raise funds by issuing bonds, or should the firm raise funds by issuing stocks? Let's go ahead and look at what a bond is first. Remember that a bond is a long-term debt instrument with a stated interest rate and a stated maturity date. If you were to purchase a bond from a company, like let's say Texas Instruments, what you're really doing is loaning money to Texas Instruments. They promise to make fixed interest payments to you. Generally it's annually or semi-annually. Then at the end of the term, it could be 10, 20, or 30 years, they'll make that last interest payment to you, and they'll also make the principal payment as well. They are borrowing money from you, paying you interest, and therefore that's an expense for them that is tax deductible. Let's go ahead and take a look at a firm who has issued debt, compares with a firm that has not issued debt, but instead has issued stock and therefore has to pay dividends. A key thing you need to keep in mind is this: interest expense is tax deductible, dividend payment is not tax deductible. So we're going to go ahead and look at those two scenarios. Interest expense versus dividend payment. We're going to look at two companies. One is a company that's issued debt, and one is a company that has not issued debt. Both companies have earnings before interest and taxes of $500,000. This is oftentimes referred to as operating profits, but the fact that it says earnings before interest and taxes tells me the very next thing I need to do is subtract interest expense. This company, the debt company, has $75,000 in interest expense that is tax deductible. No debt company has not borrowed anything and therefore did not have to make any interest payments, and its interest expense is zero. The earnings before taxes then are as follows for each company. The debt company, $425,000. The no debt company, $500,000. You can see that there is a difference of $75,000 between these companies because of that $75,000 payment. But we're also going to see how the tax deductible nature of interest expense really lessens that gap. We're going to calculate taxes now. Earnings before taxes tells us the next thing we need to do is deduct taxes. That's at a rate of 40%. So we'll take $425,000 times the 40%. That leaves us with a tax liability or burden of $170,000. For the no debt company, they're paying taxes on the full $500,000. So 40% times the $500,000 gives us $200,000 in a tax liability or tax burden. The earnings after taxes, same thing as after tax earnings. For the debt company is $255,000. For the no debt company, it is $300,000. Notice that we no longer see a $75,000 difference between these two companies. Rather, it's $45,000. Why is that? The tax deductible nature of interest expense decreased the taxable earnings and therefore decreased the tax liability owed by the company. We're just going to take this one step further and assume that no debt company chose to raise funds by issuing stocks as opposed to issuing bonds. Okay? If the no debt company paid $75,000 in dividends, we're going to see something like the following. Okay? Instead of raising funds by issuing bonds and therefore paying interest expense, after all of the taxes have been calculated, they're going to take those earnings and pay a $75,000 dividend to stockholders. That leaves us with earnings after the dividend has been paid of $225,000. And compare that with the $255,000 from the company that did issue debt. Now what you have to keep in mind is this. The fact that interest expense is tax deductible is not the only thing that we take a look at when we're making a decision. Should we raise funds by issuing bonds, or should we raise funds by issuing stocks? But it is something to consider because it does decrease the tax liability.